strong jobs, an AI boom, and oil hovering near triple digits are pulling asset prices in different directions and challenging the easy soft landing narrative. Welcome to vTalkInsight, Allocator's Lens Daily for May 11th, 2026, where we connect those forces across equities, rates, credit, foreign exchange, and commodities. In equities, indices are still trading as if the soft landing story is intact, but the foundations look increasingly uneven. The S&P 500 is tracking a sixth straight weekly gain and sits just below record highs, while the Nasdaq has been propelled by another strong leg in semiconductor names, all with volatility indicators still contained in the high teens. The core pillar for this equity strength remains artificial intelligence investment, moving from talk to execution. Companies are now embedding AI into real workflows, pushing up IT budgets, and driving forecasts for global AI-related capital spending of around $820 billion this year and close to $1 trillion next year, with order backlogs in key supply chains reportedly tripling from roughly $700 billion to about $2 trillion. That spending wave has broadened the AI theme beyond a handful of mega-cap platforms into semiconductors, memory, industrials, materials, and even parts of financials, supported by headlines such as Intel's foundry deal for Apple chips and a multi-billion-dollar data center build-out by NVIDIA. At the same time, not every link in the AI value chain is booming. Names like Cloudflare, Trade Desk, and Upwork have disappointed on guidance and are cutting staff. TSMC needs a very strong finish to the quarter after softer April sales, and CoreWeave's weaker outlook has raised questions about how durable some of these growth assumptions really are. Under the surface, leadership is narrow and valuation risk is building. Recent gains in the S&P 500 have been dominated by roughly 5 large technology names. Breadth has been mixed even on record closing days. Semiconductor stocks are up around 150% over the past year, and the Nasdaq now trades more than 10% above key moving averages at levels last seen around the dot-com era. All while U.S. equities trade at a pronounced premium to international markets, where earnings momentum is starting to improve. Meanwhile, the fundamental backdrop is becoming more nuanced for earnings. AI capex and high-end consumers still look robust, with small-cap free cash flow margins improving, yet lower-income households are being squeezed by gasoline around $4.50 per gallon. Consumer sentiment has slumped to new lows, and some airlines and other fuel-intensive sectors are cutting profit and capex guidance. So the key equity question for allocators is how long an AI-led, concentrated rally can outrun mounting consumer and energy headwinds before higher rates or growth. Scare force a broader reset, which brings us directly to the rates picture. In rates, the latest U.S. labor data reinforced the idea that policy easing is more a question of timing than direction. Non-farm payrolls rose by about 115,000 in April against expectations near 65,000, following an upward revision to the prior month. Unemployment is holding around 4.3%, and wage growth of roughly 3.6% year-on-year looks contained, a mix that argues against imminent rate cuts, but also does not justify a fresh tightening campaign. Commentators note that solid job creation and still elevated underlying inflation risks keep the Federal Reserve cautious, with some market pricing even assigning a small probability to further hikes, and focus shifting from volatile payroll headlines toward the unemployment rate as the more meaningful signal. However, there's also a growing expectation that labor softness will emerge into the summer, that a run of weaker employment and inflation prints could start to re-anchor rate cut expectations from late June, and that September becomes a plausible window for an initial move if those trends materialize. Against that backdrop, the shape and level of the U.S. Treasury curve matter more than ever for multi-asset portfolios. Many investors see the 5 to 20-year segment, where the curve remains upward sloping, as the most attractive part of the market, with 10-year yields around 4.5% and long bonds near 5% drawing buyers for income. Yet the same levels are flagged as a potential danger zone that could destabilize risk assets and widen gaps between stronger and weaker borrowers if they persist or move higher. Recent sessions have also seen a cautious bid for duration, pulling the 2-year yield below 4% and the 30-year just under that 5% threshold, even as Moody's warns on the U.S. fiscal trajectory and politics keep gilt yields near multi-decade highs. Despite those sovereign worries, demand for treasuries remains underpinned by their role as the world's key safe asset and by new structural buyers, such as stablecoin issuers, while sharp yield moves in places like the UK and Japan are creating opportunities for more diversified fixed income books. So the next few labor and inflation prints will be critical for whether yields settle into a stable range or retest that stress zone and spill over into credit and equities. Credit markets sit at the intersection of supportive macro data and rising micro stress. In public markets, spreads have been resilient relative to both equities and government bonds. Default rates remain low, and all-in yield around 5 to 6% are attracting long-term capital, with many allocators increasingly treating high-quality credit as an income vehicle rather than a pure spread or tactical trade. That benign aggregate picture masks a clear shift toward greater selectivity. Higher policy rates and talk of 10-year yields in the 4.5% danger zone raise the refinancing bar for weaker issuers, and analysts expect defaults to pick up among borrowers with stretched balance sheets and near-term maturities, prompting a tilt toward companies with stable cash flows, shorter duration structures, and business models such as software where revenues are sticky and recovery values can be modeled with more confidence. Energy is another fault line running through credit. Rating agencies point to rising fuel costs as a growing headwind for airlines, building materials, and chemicals, while energy producers and defense companies arguably benefit from the same dynamics. European airlines have already cut earnings and free cash flow guidance. One major group plans sizable ticket price increases to offset only part of the fuel shock, and expectations are building for further consolidation as weaker carriers struggle to adapt. The most acute concerns today, though, sit in private credit, a roughly $1.8 trillion market now facing its toughest confidence test to date. Sharp drawdowns in listed vehicles, investor redemptions, and comparisons to the pre-2008 period highlight worries about opaque loan quality and limited secondary liquidity, even as players like Blue Owl prepared dedicated secondary strategies after transaction volumes nearly doubled to around $20 billion last year. So allocators are watching refinancing activity, fund flow dynamics, and any signs that this fragile resilience in credit is starting to erode. In foreign exchange, the story is a gently softer dollar anchored in shifting rate expectations and evolving macro narratives. The greenback has been slipping against currencies such as the euro, sterling, and the Swiss franc, including ahead of the recent payroll report as traders lighten positions, while the broader thematic case for a weaker dollar rests on perceived overvaluation and long-term cycle dynamics rather than any single data point. Some emerging market currencies, notably the Brazilian real and Mexican peso, have outperformed in this environment, supported by relatively high carry and local fundamentals. At the same time, the Federal Reserve still leans toward eventual easing even as several other central banks turn more hawkish in response to inflation and wage pressures, a policy divergence that, if sustained, could reinforce gradual dollar depreciation provided global risk appetite does not suffer a sharp setback. Sterling offers a good example of how politics and policy intersect in FX today. The currency has strengthened against the dollar despite weak local election results for the governing party, suggesting that substantial political risk was already in the price and that markets are now more focused on the UK's challenging fiscal outlook and elevated gilt yields. So FX allocators are monitoring whether incoming U.S. data finally validate rate cut expectations, how resilient outperforming emerging currencies remain in any risk-off episode, and how de-dollarization narratives evolve alongside real yield differentials. Commodities, and oil in particular, remain the crucial link between geopolitics, inflation, and growth. Brent has been oscillating around the $100 mark, recently edging higher after a 1% gain while still digesting several down days, as markets weigh softer spot prices against signs of tightening physical balances and persistent tension around key shipping lanes. Geopolitical risk is centered on the Middle East, where clashes between the United States and Iran near the Strait of Hormuz and setbacks in ceasefire talks have kept the risk of supply disruption elevated. Analysts note that global inventories outside China are being drawn down quickly, and some warn that if stockpiles are exhausted while the conflict drags on, prices could spike sharply, although others argue that significant reserves, particularly in China, and evidence of near-term oversupply have so far limited the move in paper markets relative to the underlying tightening. The economic impact of higher energy prices is already visible. U.S. gasoline prices around $4.50 per gallon are disproportionately hitting lower-income households. Consumer sentiment has dropped to record lows, and airlines have revised profit and free cash flow guidance lower, while warning of reduced capex. With at least one major European carrier planning to pass through a substantial portion of fuel cost increases via higher fares, a pattern that rating agencies flag as a credit concern for several energy-intensive sectors. Looking ahead, the key question is how persistent this energy shock proves to be. One-year inflation expectations have eased somewhat, indicating that consumers hope current fuel pressures are temporary, yet economists caution that if oil stays elevated, surcharges in transport, food, and logistics could embed higher core inflation, complicating central banks' easing plans and feeding back into rates, credit spreads, and ultimately the equity risk premium, which is why energy remains central to any cross-asset allocation discussion. Pulling it all together, the cross-asset picture today is one of strong headline growth powered by AI capex and still solid labor data, set against stretched equity valuations, rising concentration risk, and an energy shock that is biting at the lower end of the consumer spectrum. Rates markets are leaning toward a higher-for-longer stance, with potential cuts pushed into late summer at the earliest, while parts of the curve around the 5 to 20-year area are increasingly used as income anchors rather than pure hedges. Public credit continues to offer attractive yields with restrained defaults, even as private credit undergoes a genuine confidence test and sector-level pressures emerge in energy-intensive industries. In FX, a gently weaker dollar, firmer sterling, and resilient high-carry emerging currencies frame the external backdrop, all while oil and broader commodities keep the risk of a renewed inflation debate very much alive. For allocators, the key watch points are the next few labor and inflation prints, signs of any broadening or reversal in equity market leadership, stress indicators in private credit, the durability of the weaker dollar trend, and the path of Middle East tensions and inventories in oil. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.